Hey there, welcome to the part 10 of our online session. In this session, we are going to understand open interest and option chain analysis. I need your full attention in this particular video because it is going to be very interesting session plus very important as well. So before we start off by understanding open interest, let me just go back to last video where we understood Nifty VIX PCR concept. Now, in the last video, I talked about this PCR being 1.1, which is neutral right now, and India VIX being lying at low levels. So what happened was this is showing the current expiry, which is the weekly expiry PCR. Now I forgot to change this to monthly expiry. So this is not what we have to look for. We have to go from month current to the end of the month, which is basically the monthly expiry. And there, what I have observed is the Nifty VIX PCR, the PCR value for Nifty is 1.5. Now, this is slightly bearish. So I was just going through and researching what I did in the last video. So I got to know that the PCR value for monthly expiry of Nifty is 1.5. Now, this is slightly bearish. So what happens is when the PCR is slightly bearish, you need a confirmation from VIX as well if the market wants to go down. Now here the thing is VIX as of now is still below this level. So what acted as a support earlier will now act as a resistance. So this is basically a supply zone for VIX as of now. So you do not need to worry just as of now because as you can see, it is getting rejected from there multiple times. But the moment VIX goes above this 16, 17 level and then reclaims this particular zone, and at that point, if the Nifty VIX PCR is above 1.5, then you can just be assured that the Nifty is going to fall. This is kind of an amazing technique that works almost each and every time. So you need to look at the monthly PCR and not the weekly. So I was looking at the weekly. That is why I thought, let me correct myself. So monthly expiry PCR is currently at 1.5 and the VIX is lying low. But definitely when the PCR is rising, we need to have a look at VIX. So when the supply zone is reclaimed, if it goes above this and then PCR is high, then there might be some profit booking from Nifty. I won't say down move because bears are completely wiped off the market by the bulls. It's a supremely mad bull run, but there can be a significant profit booking. So we will observe when that happens. And for today, we will understand open interest. So what exactly is, okay, let me increase the font size. So what exactly is open interest? So in finance world, as you might have known by now, the term interest basically means ब्याज. Like, hey dude, ये मैंने होम लोन लिया है, इस पे मेरे को इतना ब्याज पर होम लोन मिला है. So basically, I have taken this home loan at this particular interest rate, or I have invested my savings and I am getting this much interest on my capital. So basically, that kind of interest is what usually used in finance. But in open interest, the term interest literally means curiosity wala interest, दिलचस्पी wala interest. Okay, so it means the curiosity, the interest. The other meaning for interest is curiosity or that kind of interest. So what does open interest literally means is the curiosity of people. So what does OI or open interest say? It basically tells how many people are interested in that particular asset. What does one OI mean? OI means open interest. So we are going to use OI for open interest. All right. So what does one OI mean? So wherever one buyer meets one seller, that is where one OI is formed. So where one buyer meets one seller, that is where one OI is formed. That is how we calculate OI. One open contract from buying side plus one open contract from selling side is basically one OI. So that is how the OI is calculated. And now in OI, that's it. This is all you have to understand in OI. And then it's all about option chain analysis. So basically, open interest is used for analyzing the option chain data. But before we proceed into option chain data, you need to know of four things that are used in option chain analysis. So the first term, there are four terms basically. So the first term is called long buildup. Don't get confused. I'll make you explain everything. The second is short buildup, long buildup, and then short buildup. The third term is long unwinding, long unwinding. And the fourth term is short covering, short covering. So what is all this? Let's understand this first before we go to option chain analysis. So to explain all these terms, I will have to go to Paint to literally explain you with a graphical pictorial representation of how things work. So like, okay, this is the resistance level for some asset. Now, this is the support level, sorry, and this is the resistance. So I'll mark resistance level with R and mark support level with S. So what do you think will happen when that particular asset bounces off from support zone? Like any asset that bounces off from support zone, what is going to happen? Yes, you got it right. People are going to buy, isn't it? This that which literally means people are going to put in fresh money, people are going to make fresh entry or for fresh longs. So this basically means long buildup because literally long means what? Means buying the markets and buildup means what? It basically means the fresh entries that have been created by people. So long buildup is basically this, that whenever market is taking a support or basically whenever people enter in huge quantities or even small quantities, that is basically called long buildup. And whenever long buildup happens, small quantities में तो generally नहीं होता, it's always usually in big quantities because this option chain data is manipulated by these option sellers of uh, DII and FII people. So they usually trade in big quantities. And whenever a long buildup happens, what happens is market starts to shoot up because there's so much of quantity from these people coming into market, flushing into market that fresh long entries trigger the market and it goes up. So this is basically long buildup. Not necessary market has to take support or anything of that sort. Just a random market, any up move basically means long buildup. Similar to that, whenever market comes down, whenever market comes down, it basically means short buildup. Similar to long buildup, it is exactly opposite of long buildup. Similar concept, just opposite concept. The short buildup. So whenever you see the market is taking resistance from a level, what will you do? What do you think people will do? What do you think these institutions will do? Yes, you got it right. They will sell the market. So what happens is these people create new short entries. Basically, they short the market over here in expectations of market going down. And similar to what long buildup is, short buildup is basically new fresh entries. Got it? All right. Now let's understand next two concepts, that is long unwinding and short covering. So let's say the market is range bound and then it comes to support, takes the support and goes up a bit. So what happens over here is, as we discussed previously, people build people go long over here. So new fresh entries are made and long build up data is increased. So long build up happens over here, but these people are expecting, these long build up people are expecting markets to go like this, isn't it? And they are expecting to have much bigger profits when it takes a support like this. But what happens if the market goes down again? What happens if the bears who are here are trying to push the markets down again? So at this point, when the market breaks this support, these long people are going to cover their longs or exit their longs. They're not going to wait for their stop loss to get triggered because once the market has taken support and then it breaches it again, it most probably will take their stop loss as well. So they know, these people are professional people. These people know that, hey, now the market can literally go very, very down very fast. So they exit from their long position. So this exit from the long position basically means long unwinding. They are unwinding their longs. They are taking back their longs. Getting the concept? So long build-up is basically new fresh entries, long entries. Short build-up is new short entries, fresh short entries. Long unwinding is when the long people, the market goes against these long people and then they cover their longs. They exit from their longs, which is what called long unwinding. And then the concept of short covering is pretty much the same, just on the opposite side. Like let's say if the market goes up and takes a resistance over here, as we saw in the previous example, the sellers are going to sell the market over here in anticipation that the market will come down. But what happens if the market goes up? Like these bulls are, let's say, very, very strong, and then the market goes up again. So these professional people or institutions who created new short entries over here are going to book their shorts over here, because as soon as the resistance breaks up, they are not going to wait for their stop loss to get hunted. They are not going to wait for their stop loss to get triggered, because similar when we saw on the downside, when a support breaches, the market can go down very fast. Similar to that, whenever this resistance is breached, the market can just shoot up faster. So that is why these people are going to cover their shorts, and that exactly means short covering. So the concepts are pretty same, just on the opposite side. So long build up, short build up, long unwinding, and short covering. So these are the concepts which are basically used in option chain analysis. So let's understand option chain analysis. So here we are on the NSE option chain data. So how to get here? You just have to Google NSE option chain, and the first link will be of NSE India, and you have to click on that. It will redirect you to this particular site, this particular data. Now, let me tell you one thing first of all, that do not get confused looking at the kind of numbers that are displayed here, looking at the table that is over here, because there are so many unnecessary things that we have to ignore most of the things. We have to look at only two, three things and ignore most of the things. So don't get confused at all. It is very simple once you understand where to look for. In my opinion, they have designed it this way because the moment you look at this particular table, so many people get confused and are scared to understand this data that they do not even try to read or do not even try to understand what option chain is. That is what I think the the purpose of this so much of confusion adding being here is there, because there's ask quantity, ask price, and bid quantity. Now, what is the use of all this? You can just view all of this in your this list, whatever you add in over here, you can just view it all of those things in the order history or order data itself. So there's no need of adding all these things, but these guys are still added. Then they have LTP. What is the use of LTP? Why would I look at LTP over here? Then the change is there. So there is so much of unnecessary data that it adds up to the confusion. So what do we have to look at in the first place? So here, starting off with OI, if you can just look at my mouse, this is OI. This is total OI basically, okay? So the total OI, and then we have change in OI. So this basically means the change in total OI for that particular day. So this is total OI, and change in OI will basically indicate the change in the total interest for that particular day. So let's say you are looking on at markets on Wednesday. So what change is there from the total OI, it will indicate that change. Then there's volume and IV and all these things we have to ignore. There's just no use to look at all these things just as of now. Uh, IV will understand, but that's basically very, very advanced concept. I'm not covering IV and option Greeks in this particular beginner's course because it will just confuse you and nothing else. Option Greeks is basically the thing on which the prices of options are derived from. The prices of option fluctuate on the basis of. So that option Greeks consist of delta, theta, gamma, vega, rho, and all those things. And the IV is similar. They basically are very advanced concepts. I do not want to confuse you guys with that. The only thing you need to understand is about option is that options lose value. Options lose Options lose their premium value as soon as the expiry starts to approach. So there's this theta, the option Greek's theta concept is there. You do not have to remember the name. So what theta is basically, it indicates the decay in price. So that is why all these professional institutes and DIIs and FIIs are option sellers. The reason they sell options is because these options lose premium uh, as soon as the expiry starts to come nearby. When the expiry is not near, it is still decaying. The options are still decaying, but not at a very fast pace or higher pace. They are decaying, but at a very slow pace. But as soon as the expiry starts to approach, these options starts to lose their value. Now, which options? There are three types of options, and what are they? So the three types of options basically are in the money options. We'll understand everything. ITM, we call it in the money. So we take the initials and call it ITM options. Then we have at the money options, which we call ATM options, which we call ATM options. And then we have out of the money options, which are termed by the name OTM options. All right. So we have in the money options, we have at the money options, and then we have out of the money options. So in these options, in the money is least vulnerable to the option data. We'll understand how to figure out which one is which, but understand this that the ITM, basically the in the money options, are least vulnerable to the decay. ATM options are vulnerable to decay, and OTM options are pretty much uh, the prey of these option sellers because they are the most vulnerable options for decaying, because the OTM options start to decay their value heavily as soon as the expiry starts to approach. So, so now let's understand how to figure out in the money options, at the money options, and out of the money options. So let's go to this data. Now, as you can see, there's this gap, there's this cross connection between the X kind of thing is forming between these gray things. If you can see, these are gray boxes. These boxes, gray box, this box is a gray box, and then this below this gray one is white, and this above this gray one is white. And the reason they have been designed like this is to basically quickly understand where the current price of market is. So right now, if you see, Nifty futures is trading at 17,332. Today is Sunday, so the markets are closed, but it's 17,332. So that is why basically this is trying to say that this particular area is the current price of the market. So 17,300 and 17,350 is where basically the market is, and therefore this X kind of thing is forming. X basically means the interaction of these boxes are coming over here. They are getting interacted at this particular point. Now let's understand ITM options, ATM options, and OTM options. So now as you can see over here, these are calls, these are puts. So this is basically the call side, this is put side. Now what is call and what is put? So call is basically an option which goes up in value if the market goes up. Put is basically an option which goes up in value if the market goes down. Okay, I'll repeat it again. Calls are basically those options which rise in value when the market goes up, and puts are those options who rise in value when the market goes down. Okay, so for example, let's understand. If you want, if you are feeling that the market is going to go up from here like that, so what can you do is you can buy calls over here. Just for example purpose, I'm just trying to explain you how this thing works. Okay, so you can buy calls over here, and if the market actually goes up, your calls will gain value. The premium of your calls will gain value, they will increase. The premium of your calls will increase. Now you would say, why would I buy calls over here when I can directly buy the asset directly, isn't it? Like if this is a particular stock named ABC, then why would you call calls of ABC, buy calls of ABC if you can directly buy futures of ABC or stock of ABC. The thing is, option buying is something which can be done with very, very, very small capital. It does not require more capital, and that is why so many people are attracted to options buying. Because buying calls literally means that you in options buying you do not even have to pay the full premium. You just have to pay the premium of the calls that is there. So like let's say this particular stock is at 2500, okay, and the lot size of this particular stock is, let's say, 1000. So to buy the futures of this stock on normal NRML order, you would have you would need 2500 multiplied by 1000, that is 25 lakh rupees for NRML. But according to the leverage and margins, you need at least 2 lakhs. You need at least 2 lakhs to buy the futures of this particular stock after that leverage and margins. So you still need 2 lakhs or 2.5 lakhs to have the futures of this particular stock. What options does is, options ka value is basically going to be, if you buy the ATM calls, it is going to be between 4 to 10 rupees, somewhere between 4 to 10 rupees. And if you buy a call option that is, let's say, at 5 rupees, multiply by the lot size, which is again 1000. So what you are paying? You're basically paying only 5000 rupees. And these options go up in value insanely fast if the market actually goes your way. So like if you buy call options over here in accordance to your thinking that the market is going to go up, and if the market starts to shoot up from there, these call options will not rise rationally. It will go from 5 to 10, 10 to 15, 15 to 20, and kind of that thing. So people say that, hey, it goes 5 to 10, it basically means it is doubling my capital in 5 minutes, 10 minutes, or whatever time it is going up. So that is why so many people are attracted towards option buying, because it can be done with very, very less capital. And similarly, like this is calls, if the markets are going up and they take resistance, and if you see or feel the markets are coming down, you can buy puts. So when you buy puts and if the markets come down, then the value of your puts is going to increase rapidly. And again, it does not require any heavy level capital or high capital to buy puts or calls, basically options. So that is why people are so much interested in options buying. But the thing they do not understand is that these options, they lose value, they lose their premium every damn second. The moment I am talking, it is Saturday, Sunday, markets are closed. But even now, these options right in front of us are losing some of their value. Even today, if the markets are not opened, even then they are going to lose the value. And this is where the edge the option sellers have, they come in with. So these professional sellers, what they do is, if they feel the markets are going to go up from here, they won't buy calls. What they will do is they will rather sell puts, because if the market goes up, calls ka value rises. CE is basically a call, and PE is basically put option. So CE is call, PE is put, and if the calls value rises, it is basically, what it means is puts value is going to go down because market is going up. So that when the market is going up, puts value are going to go down. Puts का value कब बढ़ता है? When the put value increases is basically when the market comes down. That is when puts goes up. But if the markets are going up, the value of puts is going to go down. Similarly, when the markets are coming down, the value of calls is going to go down. All right. So this is how these option things work. And now when these option sellers know what they have to do, what they'll do is, when they see that market is trying to go up or take a support and start to go up, they will not buy calls over here. They will rather sell puts. Now this is called option selling. And option selling needs a lot of capital. It needs a lot of capital, and without capital it cannot be done either. So you need a lot of money to sell options. Because what happens is, the risk is basically theoretically unlimited. Like if you sell a, let's say, a put option, because the markets are going up, you, let's say, you sold a put option at, let's say, 100 rupees. Okay. Now, when you buy this put option, your maximum risk is basically what? 100 rupees. If you're buying any put option, it can maximum go to zero. It is not going to go beyond zero if you buy this, right? But when you sell at 100, the theoretical assumption can be made that from 100 it can go even 1 lakh, at least in theory, or even 10 lakhs, isn't it? This is all theoretical. This is all theoretical. Okay, but it can happen, at least in theory, or even in some cases, it has happened. Not 1 lakh, of course, but options of 100 rupees have went 2000 and 3000 rupees. So it has happened. So what happens is that the risk becomes technically unlimited, and that is why you have to pay heavy margins. The margins go up. That is why you need money to sell options. So I hope you're getting the concept of calls and puts. Okay. But this is what professionals do. Now you might ask, hey, if they are so sure that the market is going to go up, why won't they buy calls? Because of the decay, because of the value decay, because of the premium decay that is there. Now, what is this decay? The decay basically is, as we said previously, the options continuously lose the value of their premiums no matter what the time is, no matter what the market is doing, they keep losing their value. Okay, and the most vulnerable thing for option buying is basically a sideways market. So whenever the market is not going up or down, it is not showing any movement, and let's say it is just doing time pass in between a kind of range, then this is where these options are going to lose heavy premium. And that is why these option sellers who have a lot of money, they do not buy options, because what happens is sometimes market takes support and instead of going up or going down, it just keeps time passing in that particular range. And this time pass, this sideways movement deteriorates the premium of options, and they do not want to lose their money for nothing. And that is why what they'll do is they'll sell put option rather than buying call option, because whenever the market does some kind of time pass, both call and put options, both of them are going to lose premium. Now this is where these option sellers have that edge. Whenever market is in a sideways zone, call option as well as the put option, both of them are going to lose their premium. So what happens is, as an option seller, you do not have to be right to make money. You just don't have to be wrong. That's it. Like if the market comes here, you do not have to be right to make money. If you do not have to know where the market is going, you just all have to analyze this. You're not going to be wrong. So as far as you're not wrong, you're still making money, because if the markets are not going up, if you sold puts over here, if you sold puts over here in anticipation that it might take support and go up, even if the markets are not going up, let's say like this, even if the markets are time passing in a zone, you are still going to make money because the options are going to lose their value. Options are going to lose their value. This is what the problem is when it comes to options buying, that if you are an option buyer, you need to be 100% sure, or at least very much confident of the direction of the market in a specific time. You cannot say that, hey, the market I know is going to go up in the long term, so I will buy options. No, it will lose value. The options will lose value along with the time. So you have to be picture perfect with precision and accuracy when you are buying options. So like if you are buying options, if you are buying call options over here, you need to be very sure that, hey, the market in next 1 hour or 1.5 hours are going to come at this particular point, and that is why I am buying calls. If you are not sure of that, then you should not be getting into option buying. Now, option buying basically is a very difficult thing, because it not only requires this kind of special technique, analyzation, and knowledge, it also requires that kind of execution. All right. And if you feel the markets are going to go down from here, you cannot just simply buy puts, because what if the market breaks down below this support and then keeps on time passing? You are going to lose your value. So that is why option buying is considered to be gamble by many professionals. Not one, but many professionals consider uh, option buying as gamble, because it loses premium, and it is always against us. It is so difficult to make money buying options that these professional people do not believe in options buying. Okay, understood? So let's understand ATM, ITM, and OTM options now. For the call options, This basically the gray part you can see over here are basically in the money options. Now, why in the money? Let's understand. So here also the concept is completely opposite for calls and puts. So what is in the money for calls is basically going to be out of the money for puts, and what is out of the money for calls is going to be in the money for puts. Will understand that, but why and how? Let's understand that. So the price currently is, let's say, 17,300. Price is currently, let's say, 17,300. So anything that is under 17,300 is going to be in the money for calls. Why? Because when you buy calls when you expecting the markets to go up, basically the positive side. So when you expect the markets to go higher, like 17,400, 17,500 on the higher side, that is why you buy calls. So that is why anything below 17,300 is in the money for calls. Okay, in the money, but because it is in the price range of the current price, it is inside the range of the current price. So that is why a call option of 17,200, let's say, is going to be an in the money call. Why? Because it is inside the current price range. Any call that will be under 17,300, anything that is like 17,250 or 200 or 100 or 150, all of these are going to be in the money calls, and anything above 17,300 is going to be out of the money call, because that is yet to come na. This level is not yet achieved, this level, or let's say 17,350 level, this level is yet to be achieved. So this is why it is out of the current price, out of the current trading range, and that is why it is called out of the money options. Okay, so in the money options are basically those which are inside the price range. Out of the money are those which are outside the price range. And what is ATM? ATM is basically at the money. So whatever the price it is trading at is basically at the money option. All right. So this is in the money. Whatever is in the money is in the money. Whatever is out of the money is out of the money, and whatever is at the money is basically at the money option. Now this is for call side. Exactly opposite is for put side. Why? Because let's say now you are buying puts. When do you buy puts? You buy puts whenever you feel that the market is going to go down, isn't it? When you buy puts whenever you feel the market is going to go down. Same example, let's say, so 17,300, when you will buy puts when you feel the market is going to go to 17,200 level or 17,100 level, isn't it? So that is why this level, according to puts side, is yet to be achieved, is yet to be attained, isn't it? According to puts side, not calls side now. Now we are on the opposite side. So according to puts side, this level is at the money. At the money is basically same for calls and puts, but ITM and OTM completely changes. So this level from put side is yet to come, and that is why these are OTM options for puts. So what are at the in the money options for call are basically out of the money options for puts. And anything above 17,300 from puts perspective is already achieved. Like whenever you are shorting markets, this level is already achieved. 17,350 has already come when you are looking towards downside. Getting my point? So when you are looking for a downside, this level 17.4k is already done, or 17.3k is already done. So that is why this is going to be in the money. This is going to be in the money. So what is out of the money for calls like this is out of the money for calls is basically in the money for puts. And what is in the money for call is out of the money for puts. Getting it? And the ATM, meaning the at the money, remains same for the both. So the gray portion, this gray portion is in the money for calls. This gray portion is in the money for puts. This white portion is basically out of the money for calls. And this white portion is out of the money for puts. Now, getting the concept? Now let's go again to the Nifty. Uh, इसको क्या हो गया? Let's refresh. Okay, so here's the chart. Let's go again to our Nifty chart and how to use it now. How to use this option chain analysis. So we have understood what is option. We have understood what are calls. We have understood what are puts. We have understood at the money, out of the money, short covering, long unwinding, long build up, short build up. Everything is clear. Now let's understand how to use it. All right. So this thing you have to view from a options seller point of view. You cannot view this chart from a options buyer point of view. You always have to look at this chart from an option seller's point of view because option sellers are the one who control the markets. These FII, DIIs on all the institutions are basically option sellers. So you have to look at this chart from a option seller's point of view. See, there is so much knowledge in here, and once you keep on digging. Once you understand this, you can go way under this thing. We can just go into this rabbit hole and explore more and more knowledge. But I am going to explain you the basic concepts so you can work upon those basics. Because once you understand the basics, you can explore yourself these concepts as well. So you have to look at the this chart from an option seller point of view. Okay. So what does that mean? Now let's see if you are an option seller. If you are an option seller, which options will you sell considering the fact that OTMs lose value very fast, lose value very fast. ITM, they barely lose any value because they're in the money, they do not, उनको फर्क नहीं पड़ता है. And these are moderate options. These are moderately premium losing options at the money. So as an option seller, you want the premium to go down fast. As an option seller, you want the premium to go down fast because you have to collect your premiums to make profits. So which one will you sell? Right, out of the money. So these professional people sell out of the money options. And because they sell out of the money options, that is exactly where we have to look for. So this gray line, there's a differentiation between this gray line and white line, if you can see, between 300 and 350 zone. So now the current price of Nifty futures is 17,332, which is above 17,300 but below 17,350, meaning the 17,300 has been crossed. That is why for calls 17,300 is basically an in the money option, while 17,350 onwards all those options are out of the money options. All right. So you have to look at the out of the money options. You have to look at this white column and then you have to see the OI and change in OI range, these tables, these columns. So now as you can see, the 17,350 thing has a total OI of 25,466 and 17,400 is basically having an OI of 44.9k, which is 45,000. Now what you have to do is you have to find in this white box in these OTM options, you have to find which particular strike price is having the highest OI. All right. So let's search for that highest OI number. So 25, 44, this is not highest. 16, let's see if we get highest. 57, all right. 11, 40, 13, 31. So 57,600, 57,500 is basically the highest point for OTM calls. Meaning, what does this mean? This literally means that the option sellers are banging onto this call. They are selling this particular call heavily because they feel the market is not going to come over here. Here where this strike, which is this strike? This strike is 17,500. Now this again is you have to look at current expiry. In this particular column, you do not have to look for monthly expiry. You have to look for current expiry, which is weekly expiry. So this is weekly expiry data. So for this expiry, which is going to be 9th of September, the option sellers are expecting market to not come at 17,500 as of now. As of now, or at least not break this level as of now. It can change according to the movements of the market. If the market starts to go up and these people are covering their short positions, then it would mean a short covering is happening over here and they would add somewhere on these strikes, out of the money, heavy out of the money strikes, then that will mean that, hey, this level is achievable now. Okay, so this is how you have to look at these options. So let's understand again. You have to look at the total OI. So total OI for now is 17,500 for calls. Then you have to, when the market is on, you have to keep looking at change in OI, which particular strike price is getting a huge change. Any price, any strike price that is getting a huge addition of OI basically means that sellers, option sellers, professional HNIs, and all these people are entering into that particular strike. So let's say this strike is having an OI to change of OI of 5,000, and let's say within next 5 minutes it goes to 15,000 or 20,000. So you need to be careful, or you need to understand that these sellers are selling 17,550 call, which means they are expecting markets to either go down or at least not this particular, or at least not cross this particular level. Okay. So similarly, you have to look for OTM puts when you are looking for uh, puts section, in the put section. So let's see OTM puts में सबसे ज़्यादा OI किसका है? 61,000 is what I am saying. 56, 59. Okay, so 61,000 is the max OI in this range, which is again what level? It is 17,000. So what is currently happening is these option sellers are selling 17,000 puts and 17,500 calls. This is literally what it means. After 61,000, there's high OI on 56 and 59. So basically this OI column on put side is way higher than the OI column on calls side, because as you can see, calls is what? 25, 44, 16, 11, 40. But here the OI is way too high, 44, 21, 59, 56, 61, which means if you compare these columns and if you find that one particular column is having more OI than the other, then you have to understand that these sellers are selling that side. Meaning right now the puts are getting sold by these option sellers more than calls. So these are optimistic. These option sellers are currently optimistic on markets. All right, getting my point? Why optimistic? Because as we saw in this example, if these people sell puts, if these people sell puts, they are not expecting markets to go down. If they are expecting markets to go down, why would they sell puts? Because if the markets go down, puts का value तो बढ़ जाएगा. So they will lose. And these people never lose. These people hardly lose any 5% of the time, because they are the ones who are controlling the markets. These people hardly lose. So why would they take a loss for no reason? So if they are selling put, which literally means if they are selling puts, means markets are not ready to go down. Nope. Market are at least, if not going to go up, they are at least going to go sideways. It is not going to go down. So they are selling puts means they are expecting markets to go up or go sideways. These are the two possibilities coming forward. So these levels basically indicate the support and resistance as well. So 17,500 for now is currently where the support is, because that is where the max OI on OTM calls is, and 61,000 is where 17,000 का 61,000 का OI is basically on 17,000. So 17,000 is currently the support. So right now for market 17,000 is support and 17,500 is resistance. These levels also act as a psychological level. Psychological matlab kya? Psychological is a whole number basically. Anything is like 15,000 is psychological, 16,000, 16,500 is psychological. Similarly, for a stock that is at trading at 95, let's say. So for that stock, 100 is going to be psychological, or 150 is going to be psychological. So these are called psychological levels. So I hope you have understood this now, that how these option sellers choose the strike price. Now, because there is so much of selling going on into these put options, what other option sellers will do is they look at this data and they start selling put options as well. They start selling put options as well, and which creates huge open interest on puts side. As you can see, the total OI over here is way more higher than the total OI over here. You can calculate it yourself, but I am just, it is clearly visible to a naked eye that 61,000, 56,000, 59,000, 43,000 is just way more than these 16,000, 11,000, 13,000, 40,000 things. Okay. So let's understand what is long build up, short build up, long unwinding, short covering now. So in live markets, whenever you see any particular strike that is getting uh, high levels of OI, high levels of change in OI, that basically means वहाँ पे addition हो रहा है. That basically means वहाँ पे addition हो रहा है. That is basically long build up going on over there. So like this particular strike price, let's say 44,900 वाले strike price में अचानक से the OI starts to rise from 17,000 to 35,000. It means either these people are selling these calls or someone is heavily buying this call. Now, how would you understand that? You would understand with the help of price action. If the uh, markets would react to such kind of reaction. So if it is a long build up, if someone is heavily buying these calls, market would start to show some up move momentum. Okay, because market reacts to everything. And if it starts to go down, then you have to understand that someone is selling it out. Someone is selling, someone is creating a selling pressure on these particular strike price. So we do not have any option of seeing that the addition that is being done is by sellers or buyers. We do not know that. But again, as I said, you have to look from a seller's point of view. So that is how we see. We look at it from a seller's perspective. Let's see what is short covering. So let's say this 17,000 people or 17,000 OI is here, 44,000 total OI is here, and this is a out of the money call, which means if the markets start to go up, this price of this OTM option is going to rise. So if let's say the price of this call starts to rise or the market starts to go up, this call is going to go higher in value, and that is exactly where these option sellers are going to cover their shorts. So from 44,900 you are going to get it go you are going to see it drop to 40,000 levels or 35,000 levels, and that is an indication of short covering. Basically जो short किया था option sellers ने, the short that was created by option sellers are getting covered. All right, getting my point? Short build up, long unwinding, short covering, all these things are clearly visible on chart. So let's say now we know that the puts are getting sold. All right. Now we know that the puts are heavily getting sold because the people are, the option sellers are basically optimistic on market. So let's say on Monday morning, whenever the market next opens, let's say the market starts to show up move momentum, okay, in the morning itself, and then you start to notice huge change in these OIs. Let's say these or these. Let's say this 42,000, uh, sorry, this 56,000 OI changes suddenly to 70,000. Suddenly, just because the markets are going up, people are interested more in selling puts. So let's say this particular OI or this particular OI suddenly starts to go up in value. The OI change in OI starts to go up in value. So that is where you have to understand that hey, people are busy selling this particular put. So the short buildup is getting created on this particular strike price. That is how you identify long buildup, short buildup, long unwinding, short covering, and all of those things. So do not get confused. It is very simple once you understand or start to apply all these things. At the first session itself, it is going to be difficult. I can understand, but you just have to watch this session again and again, two, three times. So you get to so you get a hold of what this is really is. And once you start to understand this in live market, you will get a better grip of what option chain is, what option chain analysis is, how to interpret OI data, how to understand all these things and everything. Okay, so do not worry, do not get stressed, do not take any tension that hey, I am not understanding this. It is bound because it is difficult at initial levels, but once you start to understand, it becomes very easy later on. So this was just a beginning of uh, option chain analysis. There's so much you can do once you understand the markets. There are various strategies that you can use and stuff like that. So you can understand all of those things later on when you get a grip of what option chain is. Now this is not only used for index, but it is also used for stocks, FNO stocks, like let's say Tata Motors is in FNO. So we will search for Tata Motors, and Tata Motors may, when we click, you can have a chart of Tata Motors. So it will indicate what happened. Why are you not giving me the chart? Let's see. Trading status active. क्यों नहीं दे रहा है? Okay, wait a minute. So let's search for what? What is an FNO other than this? There's HDFC. It should give a chart, no? Why is the chart not coming up? The table. Just like the Nifty thing, there's a table for stocks as well. So you can analyze the option chain data of stocks. Why is it not coming up? Okay, over here it is. We were searching over here. Over here the select symbol thing is there. So let's go with Bajaj Auto. So now you can see, let's see what the Bajaj Auto ka current price is. So Bajaj Auto is currently trading at 3757. So that is why 3750 and 3800 ke beech mein this is getting interacted. So these are in the money calls, these are in the money puts, out of the money puts, out of the money calls. So now you have to see what or how much OI is getting built up on which side. So यहाँ पे it is 156, it is 465, it is 108, and then you see all of a sudden it's 1000, 326, 600, which clearly indicates that option sellers are busy selling the OTM calls of Bajaj Auto. When you sell calls, when these option sellers are selling calls, they are not in a mood of letting the markets go up. But this is not all, because this is showing you incomplete data. Why incomplete? Let's understand. Because this can be a buyer's position as well. We are just assuming that these are sellers now. What happens if this is a long position created by a buyer who has bought 3800 calls in expectation that market is going to go up? Is that not possible? It is possible. So for that, we have to understand where the chart of this particular thing is. So we have to look at the chart, and then if the chart is positive, if the chart is positive, we will look at daily chart. If the chart is positive, then it will mean that hey, those are option buyers and not sellers. But no, the chart is not positive, it is just coming down, which clearly says that that particular thing was option sellers entry. So because the stock is in a downtrend and these option sellers are expecting Bajaj Auto to go down, they are selling out of the money calls. So this is not a buyer's entry. If this was a buyer's entry, the stock would have been going up. It would have been going up, but it is coming down. So now it is a seller's entry. It is confirmed that it is a seller's entry. Let's analyze few more stocks to understand how this works. Let's go with Concord. Okay, let's add Concord over here. So we will understand what the price is and how the chart is. So Concor is trading at 727. So let's see where the option sellers are. 40, 57, 18 on this side. On the other side, 379, 321, 135. Question over, game over. You are clearly getting that someone is clearly making very heavy positions over here. How would you know if this is a option buyer taking calls or option seller selling calls? Simple. Let's go to chart and understand what the trend is. If the trend is negative, it simply means those are option sellers busy selling out of the money calls. And if it is going on the upside, then it means that hey, this is options buyers over here. But it is highly unlikely because the chart is mostly determined by these option sellers only. Okay, so it is range bound as of now, like if you can see, and it is trying to go up, and then if this breaks out, okay, this might be option buyers. These people might be option buyers, right? Because the chart is going up, It is a range bound consolidation, but they are expecting this chart to break above this particular resistance. So they are not sellers, they are buyers. So this is how you came to come to understand what or who these people are. Okay, because the chart is in uptrend, and then you see here is a long, the OI is just way too much. This means people are buying these OTM calls in expectations of market going up. So this is how you decide. Without the context of the chart, you are not going to understand anything, because you would not know if these people are buyers or sellers if you don't have a look at chart. So only option chain is not going to help you in any way. You have to look at chart. Like, let's see another one. Let's go for Kotak Bank. All right. Let's see a chart of Kotak Bank as well. Kotak. Why I am looking at daily chart? Because daily chart gives a idea of how stuff is with that particular equity is going on, how the things are with that particular stock. So let's see where the OI is. 891, 351, 903, 750. Not one four-digit number. On the other side, 1598, 1021, 1261, all of those are four-digit numbers. So it is clearly indicating that there is higher interest at calls. If you see this in the money call, it is just 4,792. Huge, whopping interest in out of the money and in the money and at the money calls for Kotak Bank. Are these buyers or sellers? Let's understand by having a look at chart. Okay, so these are who these people are. These might be buyers because the stock is in upside momentum since few days after a range bound consolidation. If they are thinking that this particular level might break like this is the resistance if you can see, and it is very close to resistance. So they are buying. People are again long on this particular chart, this particular Kotak Bank, in anticipation that this level is going to break. So this is how you decide who these people are. Because now, when chart is almost like this, when it is about to break this resistance, you have to understand that option sellers are not going to sell calls. Because if the market is going to go up and they know it, they are not going to sell calls. So this is how these things work. How I hope you are getting a grip of how things are working in this particular thing. Let's see PVR. These are just random charts I am viewing. These are not pre-planned charts. नहीं तो बोलोगे हे आपने पहले ही बना के रखा था and now you are showing us and all that. I don't believe in all those things. These are just random charts that are popping in front of me and I am just having a look at it. So let's understand PVR. कहाँ पे सबसे ज़्यादा OI है? 30, 18, 240, 152, 63, 284, 749. Oh my God! Again calls. Calls में buying हो रही है. Buying हो रही है, selling हो रही है. How would you know that these people are buyers or sellers? You have to look at chart. Okay. So now this is a confusing chart because if they are buyers, then it is consolidating basically. So it is highly unlikely that these people are buyers. It is consolidating. If you see, it is going in a range bound range. But still, because the stock has showed a previous up move, we might say that these people can be buyers, just optimistic people. Because if in any way the stock is in up move, the option sellers are not going to sell those calls. And in any way, if the stock is in up move like this, then those people are not going to sell those calls. So this move uh, this might happen that the PVR can just shoot up. Like this is what I guess the expectation of these people may be. But if you see clearly, there's not much of OI buildup. There's like okay OI. So there's not much of interest in PVR chart because the numbers are saying it. There's less interest in PVR charts of people rather than Kotak Bank or other particular things. So wherever the interest is less, we will avoid those particular scripts. We need those scripts where the interest of people is high, because that wherever the interest is high, it adds up to the liquidity, and whenever the liquidity is high, volatility is high, and because volatility is high, the stock generally or the asset generally does not move in a range bound thing. It breaks out or either breaks down. Let's see TCS. Okay, we'll have to look at TCS chart also for that thing. TCS. I hope you are getting these things because although these may look difficult at this point, but once you get a hold of option chain and open interest, all these things are very easy. Okay, so here we are at the money and let's see which calls are getting more interest. 126, 111, 708, 154. All right, 480, 274, 1745, 276, 247. Clearly, something is going on in calls. Something is going on in calls. These are either sellers or buyers. Who are these people? How would we know? Let's go to daily chart of TCS. Now I don't even need to tell or say who these people are. You guys are smart enough to understand. You guys have completely gotten an idea, haven't you? For those who haven't got an idea of what this is happening, people are busy buying calls. The far OTM calls also all getting bought. See, 1868. Oh my God, 4000 wale call में 1868. So basically, people are expecting TCS to reach 4000, this level, sooner or later. So that is why these people are buying those calls. And because of the more TCS is giving right now in such a mad bull run, these people are buying calls, and these all options that are there are getting sold. These options, this 708 that you see over here, 1560 that you see over here, these 3700 call, 3720 put, sorry, put, these puts are basically getting sold by these option sellers. So I hope you got the context of how to understand OI, how to read this option chain data, and how to understand it basically. If you have any doubts regarding option, chain, or open interest, ping me. You have my Telegram ID. You can ask me your doubts anytime. I am there to help you out. But once you understand all these things, it is going to be very much easy for you to analyze stocks and index. So I hope you got this thing, and in next session we'll conclude this session for now, and in next session we are going to have a look at the golden rules of trading, the rules, the things that you should be doing and the things that you shouldn't be doing. It is also going to be a very important session for you. We have come a long way from understanding candlesticks to literally reading option chain data, and next session is going to be our last session where I'll explain golden rules of trading, how you can get consistent, and how to manage your emotions, which is most important. So I will see you in the next session. Until then, you guys keep revising all these things, and if you have any doubt, feel free to ping me. So I will see you in the next one. Tata, bye bye. You guys take care.